Good afternoon, Jiang Yu. Could you please show me yourself?
Oh yes. Wait. Okay.
Hello.
Hello, Professor.
Good afternoon. Nice to see you.
Thank you. Nice to meet you.
Matt. Good afternoon. Mark. No. So good afternoon, Mark. Mark, maybe.
Mark 是什么？Mask?
Sorry. I'm not speaking to you. I'm not talking to you.
Okay.
Yeah. There are another students just joined. Hey, all the way during class, please show yourself, okay? Don't turn it off. Don't turn off your video. Mm-hmm. Kang, Miss Kang, you're from Korea or which country? Kang Sing.
Hello,
You're
Professor.
from China?
Yeah, I come from China.
Oh, okay. I see. Kang, okay. Hey guys, show yourself to me. What's the problem? I'm showing myself to you guys. There should be no problem with you guys showing yourself to me and others as well. Okay. Good afternoon, everyone. Okay, let's 2 minutes before 2 minutes to 30. These days, the exchange rate is really fluctuating. So I think many students from foreign countries may, I don't know, suffer from the fluctuations in the exchange rate, maybe or maybe not. So maybe next week, maybe 1 or 2 weeks later, we are going to talk about exchange rate. So, which may be interesting to you guys. Okay, let's get started because we are behind schedule. So good afternoon, everyone. Today, this long-term financing, second lecture on long-term financing. Financing in the corporate finance, we usually means equity financing or debt financing, right? Equity financing means issuing stock, right? Debt financing means you may take a loan from bank loan or you're issuing bonds. Okay, so the long-term financing we usually means when it comes to long-term finance usually means raising capital through issuing stocks or bonds. Okay, then the key is the key is the cost of this financing, okay? Cost of this financing. That is gonna be key. Okay, main topic. So before we talk about the cost of equity and debt, let's recap the previous lecture, okay? Which I think most of you guys find a little bit difficult to understand. First of all, risk. Risk is a deviation from expected return, okay? So any surprises from your expectation is kind of a risk, okay? So in corporate finance, we use some statistics, right? So based on the historical return, we calculate some statistics. For example, standard deviation. So standard deviation is the how much the actual return deviates from the average return or expected return, right? So expected return is the return you expect in the future, right? So in the future, when the actual return is different from your expectations, expected return, that is deviation, and which is called risk, okay? So standard deviation or variance is a statistical measure of deviation or risk, okay? So you should have this definition in your mind. And diversification of a risky asset or portfolio of risky asset minimizes or eliminates avoidable or unsystematic risk, but is still exposed to unavoidable or market systematic risk. Okay, so it is impossible to be from any risk, right? There's no way. There's only way to be from any risk. There's only way. What's that? Death. Okay, death is the only way to be from any risk, right? As far as you are alive, there's no way to be from any risk, right? And the risk is consists of systematic, unavoidable risk, and avoidable risk. Okay, so we divide the risk in this into the two types. Okay, and the diversification is gonna reduce or eliminate this unsystematic risk. But this unsystematic risk could lead to alpha. Okay. Statistical relationship in changes of expected return between capital market, stock market, capital market or stock market, for example, and an individual stock is called beta. Okay, so the relationship, the level of between the level relationship in the level of changes in return between stock market and an individual stock is called beta. So beta basically derived from the statistical analysis of historical returns. Okay, so whenever you want to forecast the future of something, you always need to report to the historical data. Okay, so depending on how the technique is, how much the technique is sophisticated, using the historical data, you may be close to the your expectation may be closer to the actual return, but it is almost impossible to precisely predict the future results, right? We know that, but the investors want to reduce the risk, the deviation from our expectation as possible as we can, right? So that's why we come up with this kind of concept. Based on the returns, historical returns of the market, if we compare the changes in return of a single securities, where with the changes in stock market, where then we may be possible to predict the changes in the return of a particular stock, depending on how the whole stock market changes. Okay, because there is no way to eliminate the market risk, right? The market is always changing, right? According to the market risk, unavoidable risk, systemic risk. Okay. I hope you guys understand. Covariance of a market and stock divided by variance of market is beta of stock against the market risk. Okay. So covariance of market and divided by variance of market is just 1. So the market risk or market beta is just 1. Okay. So when the stock, single stocks beta is higher than the market beta 1 or less than 1, it means that the changes of return of the stock is higher or lower than the rate of changes in stock market return. Okay, market return. So this is delta, the changes. Okay, so it's all about the rate of changes. Okay, when the stock market, the whole stock market changes in terms of rate of return, how much a single stock's rate of return will change, how much sensitive the return of a stock is to in relation to the changes in the whole stock market. That is the beta. Okay, that's the definition of beta. And then using this beta, we can calculate the expected return of equity. That is CAPM, capital asset pricing model. So capital asset pricing model, the key is the beta, right? Beta is the risk of a single security. When it comes to the stock market, beta is just 1. Then expected return of a market is gonna be, right, just the expected return of a market if a beta is 1, right? So, but so if one single stocks, if a particular stock's beta is 1, then the particular stock's return is going to be the same as expected return of market, right? But most securities beta will not be 1, maybe higher than 1, lower than 1, right? Okay, so this is the kind of a brief summary of the previous lecture on the beta and CAPM, the capital asset pricing model. So understanding this concept, this approach to the estimation of cost of equity, we are going to move to weighted average cost of capital and the capital structure. Okay. Okay. So, but I think it's worth taking on some questions. Okay. This is just exercise of your simple. This is a very simple exercise of CAPM. Okay, pretty simple one. we have these three companies and beta. Each company has different beta, and the estimate equity risk premium is 4.4, 5.5, okay? And the risk-free rate, what is this? No. Risk-free rate is 2.8, 2.0, 1.7. So then required return of each equity. Let's take BP. So a total, these are all petroleum companies. Sorry?
Sorry, I accidentally unmuted myself. It's okay.
Okay. Let's take this one, second one, BP. So what is the required return on this stock, BP? So we have to use, if we use the CAPM, right? We can estimate required return on this stock, right? So CAPM. So first, risk-free rate, right? As time goes by, we are supposed to earn this risk-free rate in the future, right? And then plus, what is the market premium? Equity risk premium is 5.5. 5.5 is the result of expected market return minus risk-free rate 2.0, right? That is the 5.5. And what's the beta of this stock? 0.78. Okay. So this is going to be cost of equity or required return on this equity. Okay. The same formula will be applied to other stuff as well. Any question? Pretty simple, right? It's just applying application of the formulas to these numbers, using these numbers. Consider the following information: stock 1 and 2, market risk premium is 7%, and the risk-free rate is 4%. Okay, which stock has the most systematic risk? So this question is about which stock has what? If you interpret it another way, which stock has higher what? Higher what? What do we find? What should we seek to solve this question? Which stock has a more systematic risk means that which stock is the same as saying which stock has a higher beta, right? The same. So stock 1, expected return of stock 1 is depending on each state of economy. Stock 1 has different expected return, right? So we should consider this OR, right? So just multiply each one. So 0.25, 0.404 plus 0.6 multiply 0.22, right? 0.15 multiplied by 0.16. This is going to be expected return. Okay, this expected return based on the CAPM. If we use CAPM, then this should be based on 4% risk-free plus risk premium is 7%. 7% multiplied by beta. right? So then we can calculate beta if you rearrange these numbers, right? So then beta is going to be, right, -4 divided by 7, okay? Okay, so the same goes for the stock 2, okay? So then if you compare stock A's beta and the stock B's beta, so the stock which has a higher beta has more systemic risk, right? More systemic risk means that the stock which has a higher beta has more tends to move high, move higher in terms of changes return than the other stock which has a lower beta in terms of against the whole, against the whole stock market. Okay. So the level of sensitivity to systemic risk. So the higher the beta is, the more the stock is risky. Okay. The riskier the stock is. Okay. Pretty simple, right? Should be no question about this question. So I'm gonna move on. Is it possible that a risk asset could have a beta of 0? Is it possible? Minja, is it possible that a risk asset could have a beta of 0?
I think it's not possible. Maybe risk-free asset is a beta of 0, I think.
Okay, so beta is basically a systematic risk, right? Systematic risk. So if beta is 0, if beta is 0, this means that this asset, this risk asset, has no response to the systemic risk, right? So then we can if an asset has a 0 systemic risk, it means that this asset may have only unsystematic risk, right? So as you know, we have 2 types of risk. One risk is a systemic risk, the other one is unsystematic risk. So when we say risk, it does not always mean just a systematic risk. We should also consider unsystematic risk. So when beta is 0, systemic risk, maybe it would be 0, right? But still there is an unsystematic risk. So if the asset has an unsystematic risk, we still can call the asset risky asset, right? As far as the asset has unsystematic risk, right? So either unsystematic risk or systematic risk, as far as the asset has either one, we can call the asset risky asset, right? So basically, it's possible to have a 0 asset for the risky asset. For the risky asset to have a 0 beta, but then this asset is going to have only unsystematic risk. Okay. Okay. Thank you. Based on the CAPM, CAPM, what is the expected return on such asset? So if beta is 0, then what is the expected return of this asset that has 0 beta? What is the expected return based on the CA CAPM? When risky asset has 0 beta, what is going to be expected return of such asset under the based on this CAPM? Huang Shuri.
Yes, I'm here.
Uh-huh.
I think maybe if the beta equal to 0 and based the CAPM formula, we can get the where the expected return will equal to the risk-free interest rate.
Right, risk-free, right?
Yeah.
Risk-free, based on the CAPM, we are supposed to expect only risk-free rate of return, right? But that's not reality, actually, right? That's not reality. Only based on the CAPM, because if you are lucky, you could have some return from unsystematic risk, right? For example, I purchased some risk asset which has a very which has its own unsystematic risk. So then, just out of luck, I had a very good environment where that stock really fares well in the market. So you could say, oh, why not more than a risk-free rate of return, right? But as far as the CAPM CAPM is concerned, we are supposed to expect only risk-free rate of return when beta is 0. Okay. Okay. So we should think in the context of CAPM. Okay. Thank you. Good job. Is it possible that risk asset could have a negative beta? Clara, is it possible to have for the risk asset to have a negative beta?
I actually have no idea.
Oh, okay.
I don't understand what negative beta is.
Negative beta, okay. Positive beta, we just talk about 0 beta, right? And negative beta. Okay, so beta is by the definition, we can make a similar, many similar definitions. So beta is basically sensitivity of stock return to the changes in the whole market. Okay, so if the particular security has particular stock has a positive beta, it means that even while there may be some differences in the degree of changes, but when it comes to direction, when market goes up, then the stock price, the particular stock price also goes up when that particular stock has a positive beta. But when the particular stock has a negative beta, when the stock market goes up, the stock price of that stock goes down. So positive beta means that positive relationship in changes return between particular stock and the stock market, and negative beta means inverse relationship in changes return between single stock and the whole market, right? So it is possible, right? It is possible for risky asset to have a negative beta, right? Because some stocks may respond negatively to the market risk. For example, if you sell umbrella on a sunny day, right? The weather, the sunny day is a kind of a market risk, right? We cannot avoid the sunny day, right? But the shop, the company who sells the umbrella, the price, the stock price of the company is gonna go down, right? When the whole market may be booming because of the good weather, right? Something like that. What? Okay. So now you understand, Clara?
Yes, Professor, thank you.
Okay. What does the CAPM predict about the expected return on such an asset? What does the CAPM predict about the expected return on such an asset? I mean, this one. I think I just explained to you guys, okay? Any questions? Any questions? Marco, are you okay?
Yes.
No question?
Not right now.
Okay. Let's move on. So at the end of the last lecture, we talked about weighted average cost of capital. So using CAPM, we could calculate, we could estimate the cost of equity, right? So assuming, given that the cost of debt is relatively, relatively easy to find, depending on the proportion of debt and equity in the total value of the company, we can get weighted average of cost of capital for the firm, right? This is quite straightforward. So this is proportion of equity in the total value. This is total value of the firm. This is the proportion of debt in the total value, okay? And this is the required return of equity. Probably we can get this required return of equity using CAPM, okay? And then this is the cost of debt, probably interest rate, right? And this is a tax cost or tax rate. Why do we multiply 1 minus tax rate? Because interest is tax deductible, right? So this is the way how we calculate weighted average cost of capital using cost of equity and cost of debt based on the proportion of each capital in the total value of the firm. Because, you know, if you look at the balance sheet of the company, right? On the right side, this portion is debt. This portion rate this portion financed by debt, this portion financed by equity. We just simplify, okay? We just simplify the whole value of the company based on the two types of financing, okay? So then this is the, using this capital, we purchase an asset. Then out of this asset, we make a business and we run the business, and the result of performance of this business is going to be represented in income statement, right? This income statement will reflect it into equity, asset, and debt, right? So the value is this portion or this one, right? This should be the same. So total value, the proportion of equity in the total value, proportion of debt and the total value. So this weighting is applied to each cost of capital, cost of equity, cost of debt. But in case of cost of debt, the interest rate, because the cost of debt usually interest, right? So interest rate, interest expense, because interest expense is the tax deductible, you multiply the 1 minus tax rate, right? Understandable? This one, the same as before, but the only difference is this one is cost of preferred stock. Preferred stock. You guys remember? You guys may recall, preferred stock is kind of a hybrid security, because preferred stock has the components of some components of debt and components of equity, right? If you have a preferred stock means the preferred stock is supposed, the preferred stockholders supposed to receive dividends every year, right? So if you don't receive dividends on a specific, that dividend amount will be accumulated. Okay. So that is kind of the same as receiving coupon every year. So that is kind of that component. But this preferred stock, like a common stock, there's no maturity, right? No maturity. So no principal amount, right? No repayment, no maturity date. So that is kind of the equity, the component in this security. So the companies also raise capital using this preferred stock. Okay. Okay, and the overall return, the firm must earn on its existing asset to maintain the value of which stock is the weighted average cost of capital, right? So weighted average cost of capital is, okay, it's like you borrow the money from the bank and then you make some money, enough money to pay interest, right? Likewise, when the company raised capital using debt or equity, the company should operating income enough to pay the dividends and interest. Okay. Otherwise, the stock price will go down and the company may go into bankruptcy, okay, or default. Usually, equity risk, cost of equity is the highest, and the cost of preferred stock is next highest, and cost of debt is lowest among three. Okay, this is called pecking order theory, which means that companies definitely prefer lower cost of capital, right? So they prefer, when they need money, they prefer first debt capital, and they prefer to raise capital using preferred stock, or as a final result, if they really need money, right, then despite the high cost of capital, they raise capital by issuing equity stock. Okay, so if a company decided to issue new shares to finance their project, it may imply that, oh, the company's financial situation may not be very good. Okay, because raising capital using equity is not quite prepared by most companies. Okay. Okay. Any question? No. Okay, ask me
Also,
if you have any question.
Professor?
Yeah.
I'm just interested what we can do with this information, like practical application in real life.
Which one? This one, pecking order theory? Yeah. Okay. Practically speaking, well, for example, a coupon, right? Coupon was in the latest quarter earnings report. They for the first time made a net income, right? But before that, they really struggled to make a profit. So they always need money for further investment. So, but during the time, I don't think there are many banks, commercial banks, which has interest in lending money to Coupang. But the only source of finance of Coupang was from Vision Fund. Vision Fund purchased new shares issued by Coupang, right? So whenever Coupang needed money, they issue shares, and issue shares, and the Vision Fund purchased stock. So they contribute the money, injected the money into the Coupang. So there's no other way but the company to finance except for the issuing the shares, because it was financially not very sound. So in reality, when the company borrows money from the bank and the debt equity ratio is rising, it is not always a bad sign that the company, it is not always bad. The debt to equity ratio, you may think the debt to equity ratio must be lower than other, but that's not the case. Depending on how what they're gonna do with the money, with the debt, that's more important. Okay, but even if they could make money, take a loan from the bank, if they issue preferred stock or if they issue new shares, that means that they do not have much money, internal money, or they may not be possible to borrow money from the bank, because bank prefers very when bank make loans to the company, they always assess the project where the lended money will be used. So yeah, so practically issuing additional shares to finance capital to finance a project is not a good sign in terms of financial soundness of the company. So, but another way, on the other hand, the borrowing money from the bank is not always a bad sign. Okay, that's what you need to know about the raising capital by the company. Companies raising capital in terms of financial soundness. So you may prefer the financially sound company rather than less sound company. Okay, so there's no always right or wrong. It depends. Okay, so let's move on. Please take on this question. This is pretty simple. Just take on this one. The company president has approached you about company's capital structure. He wants to know why the company doesn't use more preferred stock financing because it costs less than that. What would you tell the president? On face. Yeah, so why the company doesn't use more preferred stock financing? Because according to the president, he says that preferred stock financing is the cost of the preferred stock financing cost less than that. So why? How could you explain to this question? I said here, preferred stock is in terms of cost of capital, preferred stock is higher than that cost, but I'm going to explain to you later. But according to this president, where preferred stock has a lower cost than that cost, why we raise sorry, the company does not use more, so preferred stock is lower, right? For the according to this president, preferred stock cost is lower than that, according to him. Preferred stock. Then why we do not use more preferred stock to raise capital? Then there should be some explanation. Why? Why? The only reason is tax benefit, okay? Tax benefit. Here, this one. If you consider this tax benefit, then the actual cost of capital of debt is lower than cost of preferred stock, okay? So when you pay dividends, dividend is not tax deductible, but interest is always, but there are some limitations because of tax law. So, but in general, interest is tax deductible. So, yeah, the explanation is, oh, present, it is because of the tax benefits from the financing, because interest expense is tax deductible. So in the end, the cost of the debt is lower than the cost of preparation. That would be the explanation. Okay. I hope you guys look at this example. Okay, I made this Excel spreadsheet. So please look into this Excel spreadsheet. Okay, you guys may understand. You guys, I believe you guys will understand this solution. Yeah. So please look into this. Take a look at this question and this spreadsheet when you have time, please. Okay. So today we are going to talk about capital structure. Why do we have to talk about capital structure? Because hey, as I just said that. Yeah, the debt capital has a tax benefit. So the more we use the debt capital, the better for the company, right? That is quite straightforward. But so if we raise more debt, then it is beneficial to the company. Then the value of the company will increase if we use more debt rather than equity capital, because equity capital has no tax benefit. So why don't we have 100% of debt capital and 0% of equity capital, so that we have more tax benefits, and then that would lead to the higher value of the company, right? That may be possible, right? But there are some prepositions by Modigliani and Miller, which say that the capital structure may not affect the value of the company. So before we move on these propositions by the two economists, Franco Modigliani and Morton Miller, these are two famous the economists made some propositions about capital structure. Before we move on to that, just we need to understand the nature of a weighted average cost of capital. Okay, the relationship between weighted average cost of capital and the value of the firm. So, as you guys recall, value of the firm is present value of the firm, right? So, present value of the firm, the value of the firm is likewise like we calculated the value of the stock. We discount the future cash flows of the firm, right? So the lower the cost of capital, the higher the value of the firm, right? That's quite straightforward. So higher weighted average cost capital, the lower the value of the firm. The lower weighted average cost of capital, the higher the value of the firm, right? That's understandable, right? So maximization of a value of the firm means minimization of weighted average cost of capital, right? Right? Cash flow, right? This discount rate could be in this case weighted average cost of capital, right? This discount rate. So when discount rate is lower, present value will be higher, right? So then, okay, if we use more debt, right, more debt rather than equity, because of this tax benefits, I think it may be better to take leverage as possible as we could, right? That would be cash, right? So the combination of debt capital and equity capital is capital structure, okay? Capital structure. So we want to find out some optimal capital structure which produces the more value to the company, okay? So optimal combination of equity and debt that maximizes the overall market value of the firm. So that is the ideal capital structure. Before talking about capital structure, you guys need to recall return on equity and earnings per share, okay? Return on equity is net income divided by equity, right? And earnings per share is a net income divided by number of shares outstanding, okay? Okay, I'm gonna skip this. Okay, so these two economists, in short, M&M, right? M&M reminds me of chocolate. Okay, this M&M theorem is based on the basically these three assumptions. First of all, what this M&M theorem is, they believe, these two economists believe, market value of a company is the present value, its future earnings, and its underlying asset. So basically, balance sheet. So you raise capital using debt. You raise capital through equity. Then you have some business model, right? So using the money raised through this method to run this, materialize this business model, you're gonna purchase the asset, right? So this asset is going to help business model produce actual earnings, right? So earnings will be profit, right? Will be generated, okay? So, as the company has more earnings, the balance sheet, the whole asset will grow, right? Will grow. So that's how the market value of the company, increases. So this theorem believes that each future earnings and the underlying asset, and the earnings based on business model helped by this asset are the key in determining the market value of the company. So they don't care about whether you raise money through debt or equity, whatever. So they don't. They think that. I don't think the whether the money is raised with debt or equity is really important. That's why I thought they said they think that the value of the company basically how much where the company generates earnings and the asset, the underlying asset that help the business model generate earnings. That's what they believed. So they didn't think that combination of the debt or equity actually help company help increase in the value of a company. That's what they believed. The market value of the firm is determined by earnings power and the risk of its underlying asset, right? So they made two propositions, 1 and 2, right? So when they make this proposition, they some key assumptions. One assumption is we are in the perfect efficient market. Perfect efficient market. You guys remember perfectly efficient market, right? Where all the public and private information are available, right? All the investors are rational, and all the information are reflected immediately reflected in the market price, and the investors are all risk averse, right? So perfect efficient market, and there should be no taxes, no transaction costs, no frictions, and no bankruptcy costs. How much you borrow money from the bank, and you bust for not paying the interest, there's no additional cost for being bankrupt. Okay, so you are kind of actually there's no risk of being there's no risk for failure, something like that. Okay, so pretty competitive market. That's the assumption. First assumption is that, okay, as I said, whether the company is leveraged to unleveraged, this value means value. L is leveraged, U is unleveraged. Leverage is basically that, okay? Borrowed money, okay? Borrowed money is leverage. Leverage is, right, this one. C and so, right? The value of levered firm and value of the unlevered firm, same in terms of value. That is first proposition. Okay, without taxes, we do not have any taxes in this world of in the world of this proposition. Okay, so as you can see here, whether stock is 40% and bond is 6%, or stock 6%, bond is 40%, in terms of raising capital, value of the firm is the same. Okay, this is the first proposition. The value of the firm independent of its capital structure. Firm's value is determined by its real asset. Okay, and second proposition is cost of equity is a linear function of company's debt to equity ratio. So as the debt increases, cost of equity increases. Okay, debt, cost of equity. as the debt increases, cost of equity increases proportionally. Okay, that is the second proposition. Higher debt to equity ratio leads to a higher required return on equity, higher cost of equity. But if you use more debt, then the earnings per share also increases. Okay, so this offset the higher cost of equity. So if earnings increases, for example, cash flow, right? So required rate of return increases, but cash flow also increases. So then they offset against each other. So no change in the firm's value. This is the second proposition. You guys, I made this Excel spreadsheet. So let's take a look at it just briefly. Okay, this is market price per share, and this is total. Let's assume that this is a total share, number of shares, and firm value is if you multiply market price of share multiplied by total number of shares, then you have a firm value. Okay, assuming that no debt. Okay, assuming that no debt. Assuming no debt. Assuming the company has no debt. So this multiplication of these two, and then we want to have a firm value. So unlevered, if the company is unlevered, let's assume that the earnings before interest tax is 1.5 million. Okay, whether levered or unlevered, this earnings before interest tax should be the same. Doesn't change, right? So you want to know what will happen to cost of equity when the earnings before interest is the same, but the capital structure is different, which means that more debt, less equity, right? So what will happen when we use more debt? Given why the earnings before interest, the actual actual income, actual revenue is the same. Okay. So this earnings before interest is the same, whether levered or unlevered. Okay, unlevered or levered. So if unlevered, then number of shares is 400,000, right? Number of net income is the same as earnings before interest tax, and this is the earnings before interest, earnings per share, right? And the free cash flow is the same as earnings before interest tax, and the cost of equity is earnings per share divided by market price. Return on equity is the same as the cost of equity. Okay. Return on equity is expected return from the equity. So expected return on equity is going to be same as cost of equity, because if investors expect something, then you should meet that expectation, right? So cost of equity is the earnings per share divided by the market price. So, and what if we borrow money rather than using equity. Let's see. If you do not borrow, right, then there's no change, right? They're all same. But if we let's borrow 20%. Before we borrow the the initial without any borrowing, we only used these share capital, right? $8 million, right? $8 million of share in terms of value. So let's use 20% of leverage. Then we use 1.60 million, and the number of shares reduced. Because we issue less shares, but instead we issue bonds to make up for the capital, right? Okay, so number of shares reduced. The difference is 80,000, right? 80,000. 1.6 million actually raised by this borrowing. Okay. So 20% of equity is now replaced by debt capital. Okay, 1.6 million. So then what happens? Earnings per share increased because the number of shares reduced. Earnings per share is here's the earnings per share and net income divided by the number of shares outstanding. Here we used share price. We used not share price. We used earnings before interest tax. Okay. Net income before tax. Right. Okay. Earnings per share increased, and the return on equity also increased. See, because earnings per share has increased, right? So what if we use 50% leverage? Then earnings per share increased and the return also increased. But when it comes to the value of the company, the same. Okay, because value of the company is the if you add the debt capital and equity capital, the same, 8 million. Okay. The initial firm value was 8 million. So even if you use different level of different level of leverage, you are supposed to have the same firm value, but and the weighted average cost of capital is also the same. If you follow these formulas, this formula is just based on this just based on this. Okay, just based on this, okay? Okay, so so if you have time, please take a look at this spreadsheet and try to follow this flow and understand why the leverage does not change weighted average cost capital. Okay. Okay. We don't have enough time. So proportion 2, as we have more debt, right? That as the debt increases, cost of equity increases, right? But weighted average cost of capital does not increase. Okay, that is the M&M's second position. Okay, this is kind of a, yeah, it was more than 60 years old proposition. So, but there's some counter arguments against this proposition. But this proposition is pretty robust and famous. Okay, that's why we still learn this proposition in this class. But when you have taxes here, let's say we have taxes, we have a bankruptcy cost, right? Because in reality, we have a taxes and we have a bankruptcy cost in reality. So let's make this proposition. Let's look at what will happen to this proposition when you have taxes and bankruptcy cost. Because if the company borrows borrows too much money from the bank, then they may end up bankrupt unless they really profitable enough to pay interest, right? So second point, with the taxes, first position, there's a changes in value of the firm because of these tax benefits. Okay, because these tax benefits, without taxes, they position was no changes in value, right? Regardless of capital structure, but with the taxes, if you have more leverage, then you have tax benefits. So leveraged company has more value than unleveraged company. Okay. These tax benefits are calculated like this. Tax rate, debt amount, interest rate, divided by interest rate. Then you have tax cost and debt. This is like if you have what is the terminal value? If you have in case of a preferred stock, right? Preferred stock. If you have a single dividend amount, and then if you have a required return R, then this is the way to calculate the terminal value of the preferred stock. So likewise, tax benefit is tax rate multiplied by debt and interest rate, right? This is the interest tax benefit, also called the tax shield. Yeah, this is called the tax shield. Okay, tax savings or tax shield. So tax shield divided by interest rate is the same as tax cost multiplied by that amount. Okay. This is important. So key is if you have more debt, then you're supposed to have tax benefits. Okay. So the more debt you have, the better for the value of the company. That's the proposition, first step proposition in the world of taxes. Okay. Okay. So this one also, if you have time, please take a look at this Excel spreadsheet. So this shows what happens to the value of the firm when the borrowing the changes. Okay, that's 70%. Then the value of the company, yeah. Earnings per share increases and value of the company value increases from 8 million. Okay, so if you have time, when you have time, please try to follow this flow. Okay, we don't have time to yeah, for this. And second one is the cost of equity is a linear function of the company's debt to equity ratio with an adjustment for tax rate. Okay, so as we have more debt, we already knew that. As we have more debt, and the cost of equity is increases, right? But now we have adjustment. We have adjustment for tax rate. Okay. This graph shows that the value of the firm, this line, is the value of the firm, and this total debt. As the total debt increases, the value of the firm increases. Level the company, okay? Level the company's value increases by these tax benefits. Okay. This is a proportional one. I think we should look at this one. Cost of equity. So if you change the borrowing proposition, let's say 0%, 14% A1, right? The same as unlevered. If you have no leverage, but let's change 60%. Then the cost of equity increases by 5.18. So as you have more leverage, cost of equity increases. Okay, return on equity or cost of equity increases. That's what proposition 2 with the text said. Okay. This graph actually, yeah, related to preposition 1. This one, the value of the company increases as we have more debt. Not this one, it should go to here. Okay. Okay. Yeah. So simply speaking, we are going to this next in the beginning next class. So simply speaking, M&M's position in terms of capital structure is that without any taxes or without any taxes in the next we are also talking about bankruptcy costs. Without any taxes and costs and in the perfect market, the capital structure supposed to mean nothing to the value of the firm. But with the taxes, the more you have debt, the higher the value of the company will become, right? But there's also another catch. Another catch is bankruptcy cost. So if you borrow only debt than equity, then upon the based on the proposition 1 and 2 with the taxes, the company would be most valuable. But the catch is the bankruptcy cost. So because of the bankruptcy cost, it is not really desirable for the company to finance only debt. Okay, so we want to talk about bankruptcy costs in the beginning of next class. Okay, so this is kind of all for today. Any questions? Okay, so then in the next class, we are going to deal with some problems for this lecture. And I'm going to speed up a little more. So we're going to talk about dividends and working capital at the same time as possible. I don't know if it is possible, but we are going to talk about dividends and working capital in the next lecture. Okay. Okay, so if you have any questions, please email me. Okay, then I try to explain further as possible. Okay, so then thank you and have a great weekend. See you next Tuesday. Thank you. Bye-bye.
Thank you, Professor. Have a great weekend.
Thank you.
You too. Bye-bye.